We're here today with Craig Lazzara, a managing director at S&P Dow Jones Indices, and we're talking a little bit about the SPIVA research series. Craig, how do you put together the SPIVA scorecards, and can we kind of dig down into what what survivorship bias and style consistency is, and why they're so important in your research?
Okay. Murray, let's start by just saying what SPIVA stands for: S&P Standard & Poor's Index versus Active. That people always wonder, what is this thing? That's what it stands for. What we do in SPIVA, and I say we because it's been a 20-plus year effort now on behalf of S&P Dow Jones Indices and our predecessor companies. What we do is to take what's called a survivorship bias-free database. That's a lot to say. I'll explain what that means in a moment. Of mutual fund returns. We get it from the University of Chicago. And then we sort funds into categories, so large cap, mid cap, small cap, growth and value, as categorize funds as much as we can. And then we ask, within each category, did the average fund in that category, or how did the managers in that category perform relative to an index that is appropriate to that style of management? So for large cap US, we'll look at the S&P 500. Mid cap, we'll look at the S&P mid cap 400. Growth against growth, value against value, and we'll make it as apples to apples as we can, so that we're comparing mutual funds to benchmarks that are appropriate for that style of management. That's the first thing. And I mentioned earlier that the database is called survivorship bias free, and there's a reason why that's important. And I can best explain the reason this way. If our listeners were to look at the returns of all mutual funds that have a 20-year record, and they do that today, what they are looking at is not the record of all funds that existed in the last 20 years. What they're looking at is the record of funds that were good enough to last for 20 years. Because along the way, what we found in doing SPIVA work, and it goes back more than 20 years now, what we found is that quite often funds that underperform tend either to go out of business altogether, or to change their styles, or to be merged into other funds. Therefore, if you don't use a survivorship bias free database, a lot to say, is a survivorship bias free database, you will get intrinsically misleading results, and they will make the active management community look better than in fact they really were.
And Craig, a lot of research fails to scrub for that, correct? It's not an easy task to do.
It's not an easy task. That's why SPIVA takes a while to get done. It's usually 3 to 4 months at the end of a year before the first report comes out, which is kind of frustrating because we'd like to have something, and other people seem to be a bit faster. But no, it is important to do that scrubbing, because otherwise you will get intrinsically misleading results. And I say misleading. It's probably better to say biased results, because what you're going to see if you don't adjust for survivorship bias is a group of funds that are above average relative to all funds that existed in that period of time. I mean, go back 20 years, let's say there are, I'll make up a number, 1,000 funds in a particular category. Over the course of those 20 years, maybe only 500 or 600 survived. The 400 or 500 that were either merged or went out of business were typically the underperformers. And so if you look at the survivors, you're biasing your answer in the wrong direction.
And then there's the problem with style consistency. I mean, it's not a big secret that active managers will go where the market is and try to secure the best short-term results that can make them look the best.
Yeah, that is a difficulty. If you have the intensive resources to analyze, fund by fund, you can probably do a pretty good job of identifying where style consistencies have crept in. What we end up doing is using Lipper style categories. So we're kind of relying on Lipper to do that part of it for us, and also we want to make sure that if a fund says its benchmark is the S&P Small Cap 600, we're not going to put it in the large cap category. So we pay attention also to what the fund's self-described benchmark is.
And Craig, that's really important for investors, because if they are investing in a large cap value fund, for example, that consistently strays over in the growth category or even into smaller caps, that's a big problem, isn't it?
It's a problem. It's a problem in performance attribution. I mean, I guess the way I would answer you, Murray, is to say, if the manager is consistently good at doing that, there's no problem. The difficulty is, presumably, when you bought let's say a large cap value fund, it's because you want to have exposure to cheap stocks. And if the manager departs from that mandate and buys, smaller companies that he thinks are attractive, or decides to buy a sector that's relatively expensive in the large cap realm because he thinks there's short-term opportunity there, if he's not correct, you're going to suffer relative to what could have been obtained if you simply owned an index of the segment that you really want. Now, if the manager's very good at it, that's fine. But the record, as you know from looking at SPIVA data, is that most managers aren't particularly good at either selection or rotation across styles. So if you employ an active manager who behaves in that way, he has the opportunity to outperform. He also has the opportunity to underperform. And the data from SPIVA are quite clear that over time, quite a substantial majority, typically underperform.
Sure. But if, again, it's kind of relative, because if a large cap value manager, using the same example, dips into a lot of growth stocks and stays there for any amount of time, and does that several different times over short periods, how do you know what you really own?
Well, no, exactly. And one of the benefits of investing in index vehicles, whether that's mutual funds or ETFs, is what you own. It's transfer. I mean, you can, in the case of ETFs, you can look every day in their websites to find out. So yes, and you lose that with active, even if the active managers are not straying from their style. The large cap growth manager we're hypothesizing here, will have different stocks at the end of the quarter than at the beginning. You really don't know what you own, except at rare, occasional intervals, which is much different than an index fund investor would have access to.
Sure. Let's talk a little bit about some of the other methodologies that are pretty unique to S&P Dow Jones Indices, and also maybe some of the innovations you brought to the industry besides style consistency and survivorship bias.
The other part of this analysis that's important and sometimes is neglected when we talk about SPIVA is a part that we call the persistence report, or persistence scorecard. At a certain level, the persistence scorecard is simpler than SPIVA. I mean, SPIVA, you have a group of managers, you have to specify an index that you're going to compare them to. With the persistence scorecard, it's quite simple. I mean, there are a number of ways to deal with it. But let's say I want to take all of the managers in a given universe and sort them. I'll take the top half and the bottom half, however they performed last year. What the persistence scorecard does is to say, how did the top half perform next year? And if there is persistence in performance, then you would expect the probability that the winners from the first period is greater than 50%, that they will outperform in the second period. Because if we're looking at halves, or better than 25% if we're looking at quarters, something like that. What you find quite consistently with the persistence scorecard is that past success is not an indicator of future success. In other words, if I take my favorite cut, and we do it many different ways in the persistence scorecard, my favorite cut in the persistence scorecard is just, let's take 10 years of data, take all the managers who were above average in the first 5 years, ask how did they do in the second 5 years, and very regularly less than half of them are still above average, which is to say they do less well than you would expect given a coin flip. The reason that's important is that in any given period, even if the majority of managers underperform, there are going to be some who are successful. Some of them are successful because they are really genuinely skillful and their style was in favor. And some of those are successful because they were lucky. How do you tell the difference? How do you tell the difference? And the one way to tell the difference is to understand that over time, skill persists and luck dissipates. A good example, go into a casino, go up to the roulette wheel and bet on red. Yeah, reasonable chance you're going to win on your first bet. Do it 100 times, you're going to lose your money. And so that's an easy example to say why do we look at the persistence of manager performance? Because if we see a manager who is able to outperform consistently, that is consistent with the view that the manager has genuine skill. If we see managers who outperform and underperform sporadically, that's consistent with the view that their out or underperformance is more likely due to luck or random events than to genuine skill.
And your findings consistently show with the persistence scorecard that there is no real persistence, that trying to pick a winning manager over any substantive length of time is just kind of a shell game.
It's the odds are against you, as with short-term periods, so too, even more so with longer-term periods. The odds are against you, and what persistence tells you is one of the worst things you can do if you are determined to hire an active manager, despite everything that you and I would urge. If you're determined to do that, one of the worst things you can do is to say, well, I'm going to pick somebody who did really well last year or really well in the last 5 years or 10 years, as if having done well historically is a good predictor of how well you'll do in the future. It is not. The data are very clear on that. It is not a good predictor. And so if you do it that way, you're not going to eliminate a source of error.
Thank you very much for your time today, Craig.
Thank you, Murray.